It's not a complicated model, and it works in all environments, First Republic founder Jim Herbert told investors in November, until it doesn't. We're recording this just after the news broke that First Republic was seized by the FDIC early Monday and sold to JPMorgan Chase. It's a stunning fall from grace for one of the most important real estate lenders in the game, and it's the second largest failure in US bank history. Worth noting that the third and fourth largest failures are Silicon Valley Bank and Signature Bank. Both of those happened in March, so it's been a pretty interesting year in the banking world. As part of the deal, JPMorgan is assuming all of First Republic's $92 billion in deposits, insured and uninsured. It's also buying about $170 billion of the bank's loans. This presumably includes the commercial real estate loan book and $30 billion in securities. Now, the government will cover 80% of loan losses for resi and commercial loans. So unlike what happened with Signature, where its buyer NYCB rejected its CRE loan book, here at least the short-term situation for the real estate industry looks stable. The lack of other suitors reflects fears of catching a falling knife. First Republic's collapse was triggered by the Fed's rapid series of interest rate hikes, which led depositors to seek better returns elsewhere. In order to keep those depositors, it had to cough out more. Meanwhile, rising rates were making their mortgage portfolio less valuable. Now, First Republic thought it could weather the storm. When Silicon Valley Bank went down March 10th, First Republic stock began tanking, scaring wealthy customers whose balances exceeded the $250,000 insurance limit set by the FDIC. The stock has lost more than 90% of its value since early March. A lot of people looked at it, JPMorgan boss Jamie Dimon told the press on Monday. The world knew it was available and no one bought it. Just like Signature, which is, it's kind of its soul sister on the East Coast, First Republic was known to be a relationship-driven bank and had a special status in the real estate industry. Related founder and billionaire Steve Ross had appeared in the bank's ads. And when the bank's stock started tumbling in March, a flurry of multifamily players wrote emotional tributes to the bank, emphasizing how the lender really understood their business and was willing to work through the hairy stuff with them. That's the big question then. Will the behemoth JPMorgan, for whom CRE is just one of many hustles, get the real estate players in the same way? Will it be as willing to go the extra mile when it comes to construction loans, refinancing, workouts, and everything else where it gets a little more complicated? If you're in the business of multifamily or brokering deals in that space, we'd love to hear your take. Let us know in the comments below.